Hey taxpayers, it's Tiffany Gonzalez, CPA here. Today we're talking about depreciation recapture. This has to do with the IRS taking back a deduction that you previously took on an asset that you depreciated and later sold for a profit. In general terms, depreciation recapture is a tax provision that allows the IRS to recapture taxes on a deduction that you previously took. The deduction allowed you to reduce your ordinary taxable amount. And so as a result of you selling an asset where you typically get a preferential capital gain tax, the IRS says, no, we need to recapture some of that and tax it as an ordinary gain. For tax purposes, annual depreciation expense reduces your ordinary income. And this also reduces your ordinary tax. So here's a great example. If you're a business that has purchased a piece of equipment worth $10,000, the IRS depreciation schedule says that you can depreciate this asset over 5 years, which basically means you can depreciate $2,000 per year. That is $10,000 divided by 5 years. So 4 years has passed and you've depreciated $2,000 every single year of those 4 years. You've depreciated a total of $8,000. This makes your adjusted cost basis in that asset $2,000. It's $10,000 of an asset minus $8,000 of depreciation you've taken so far equals $2,000 of adjusted cost basis. Now, let's say that piece of equipment is old and outdated at this point. You want to sell it and move on and maybe purchase other types of equipment. You sell that asset for $3,000. Most people would say, well, if I purchased it for $10,000 and I'm selling it for $3,000, I have a huge loss. I have a $7,000 loss, right? Wrong. You purchased the asset for $10,000. You've already taken a depreciation expense, a tax benefit of $8,000. So this $2,000 figure is your adjusted cost basis. Now that you are selling this asset for $3,000, your gain is actually $3,000 minus $2,000, which equals a $1,000 taxable gain. And here's the craziest part. This is what depreciation recapture means here. The $1,000 is taxed at your ordinary income tax bracket, not at a capital gain. Why? Because you've already taken $8,000 of a tax benefit against ordinary income, you now need to recapture this $1,000 gain against ordinary income. The rule is you have to look at two different numbers and determine which number is smaller to determine your depreciation recapture. The first number you look at is the realized gain from the sale. In this case, it's $1,000, which is $3,000 minus $2,000. And you also have to look at your accumulated depreciation, which we talked about was $8,000, $2,000 over 4 years. Which is a smaller number? 1,000 or 8,000? Clearly the 1,000. And so that's the amount of depreciation recapture that you must recognize as an ordinary gain on your tax return. As you can see, depreciation expense is a beautiful thing. It really helps your ordinary taxes. But when you sell that asset, things can start to get tricky, and depreciation recapture will do that to you. And that's why it's so important that you have an expert CPA that knows all of these rules that you can consult with before you even sell the asset to really understand what the tax implication is going to be on that sale. Rest assured that you can rely on us here at Accounting to Scale as your depreciation experts. Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.